Jonathan, I think you're muted.
Wow, what a perfect beginning. What I said was welcome to the 5ers Live Trading Room, which this week is part of the Bootcamp Trading Week. Very excited about this. Actually, I was so excited that I forgot to unmute myself. Here we got Victor at this side. Hello, Victor. Hello,
Hello,
Saul.
everyone. I'm
Welcome,
I'm very
everyone.
excited to be part of this event, and I'm sure everyone at home is very excited as well. Great start.
Yep. All right. Good stuff. So, Saul, maybe you could say a few words about this event that we got going on here. I know you wanted to come on here and cover a few points before we go into the actual education.
Absolutely, guys. First, thanks, Jonathan and Victor, for being part of this event, and thank you everyone for joining and for being a part. We're very very excited. I was reading Jonathan's lips and the excitement on his words when he was muted. But it's really because we've been working so hard to put this event together, and we've got a lot of partners involved and a lot of very cool content and the assignments and everything. And it's it's a new concept. It's something we're just trying out, and hopefully, if it's successful and it's something that you guys find value in it, we might do more often. So very excited for this week together and to share it with you. I will be having a session with you later this week. But I wanted, before letting just Victor and Jonathan take it for the topic for today, just take a couple of minutes just to answer very very general questions that are recurring and just about the flow. Okay, the whole event happens on the same page. The page you have the link to. Everything happens there. You don't need to go to other links outside. Every day in the morning, 9 a.m. GMT, will be uploading new content to that same page. So you just scroll down. If you miss the content from the previous day, you will have it there, and then you can scroll down and you will have the content for the relevant day. And not every day, but some days there will be an assignment. For example, today after this session, later on the session, Jonathan and Victor will go, will explain what's the assignment for today. And below this video in the page, you have a link for the assignment. You can click on it, and inside the page of the assignment, you have a tutorial video. It's very very important to watch the tutorial video. It's a couple of minutes length, but it will really clearly explain you what to do for the assignment. Now, these guys, the whole event is we've put from our side everything we could to bring all the content and all the assignments and the value and everything behind the event. Now it's up to you guys to take everything you want for yourself. We don't know if you're experienced or beginner, if you're struggling with maybe technical analysis or risk management. So we have a really comprehensive agenda that will cover all these topics for you to practice what you need the most. So really take the most of the event for yourself. If you miss one of the live sessions, you can always go back. They will be recorded. All the the pre-recorded sessions are available there. And if you miss one of the live sessions, it will stay there in the page, so you can go back and watch it. So don't struggle with that. And lastly, unless there's more questions you guys have from the audience, but the bootcamp. Okay, everyone who has already signed up for the event, next week, okay, in the maybe Monday or Tuesday next week, we will be sending you a link to be able to buy the bootcamp account. And in a nutshell, the bootcamp account is our 3-step program, our 3-step evaluation that starts on a 5K account and grows into a 10K account and then a 15K account, and then the funded account is a 20K bootcamp. Okay, so don't get confused if you get a 5K evaluation. We just want to make sure you can grow accounts and adapt your lot sizes accordingly. So the first step of the 20K bootcamp account starts actually on a 5K evaluation account. Okay, so don't get surprised by that. And that's it. If there's any question, there's all the support channels we usually have. So just have fun and enjoy the the event.
Yep. We're gonna have fun. We're gonna have fun indeed. It's gonna be a fun week ahead. I'm really looking forward to this. And so today I'm gonna talk about fundamental analysis. not fundamental analysis. I'm going to talk about the fundamentals of technical analysis, which is completely different to fundamental analysis. And then Victor will talk about some of his expertise with technical analysis. Guys, if you do have any questions to Saul while he's on here, let us know. One thing I wanted to mention as well is because you can still sign up. I mean, I've been getting a lot of emails saying people are too late, they're sorry they're too late and can't sign up, but we have extended the time period so you can sign up during the event. There will be a link in the description of this video. You can still sign up for the event. And what's important is when you're signing up and you're subscribing to our YouTube channel, it's very, very important that you also select the bell notification button when you're subscribing to YouTube, because we got such a huge number of people in this event that YouTube is actually removing some of the subscriptions. So you have to make sure that you tell YouTube that I'm interested in this. So hit that bell notification button. It's super, super important that you do this. And then, of course, at the end of the week, when you've delivered all the assignments that we're going to go through, one of them is we're going to go through that today. At the end of the week, you will get access to a bootcamp evaluation program for only $10. And like Saul said, it starts at 5K, but it doesn't end at 20K. You can continue to scale it once you're funded. Correct? And you can scale it all the way up to millions of dollars, even up to $4 million. It's pretty insane. Imagine that. You're getting a full week of trading education. Not only are we telling you what we think you should be doing to land a funded account, we're also telling you how to keep that account and continue to grow that. So for only $10, you have the possibility of actually landing a funded account with 4 million. It's pretty insane when you think about it, actually.
Yeah, it really is.
Yeah, the potential that this brings
I think you know what? I think
huge.
Saul probably has a lot to do right now in the back end and with everything at the office. So if you want to go, that's completely fine.
I'll go. I'll just mention one last thing. For the event, we've granted a demo account. This is just for practicing purposes. The demo account has no target and no daily loss, no maximum loss, nothing. It's just an account to look from the inside the trading conditions we offer, and to practice some of the assignments for this week will require an account, a trading account. Okay, so don't try to make a lot of money. We're not, we're not looking at the P&L of that account or anything. Just keep it so you can use it during the week, because you will require it. Okay, so with that said, guys, sorry, Jonathan.
Where can they find the demo account?
Yeah, so at the very bottom of the page, maybe can I show my.
Let me open that up if you want. You have it right there. So I'm going to bring you up on screen here.
Yeah, so this is the page of the event. So, there's an introduction video, and right there's a tutorial on how to get the account. Okay, the steps to get your demo account. And then in this click, that's the link to get the demo account. Okay, and then you have the content from today, and below that you have the assignment for today. So if you click on that assignment, it will bring you to the assignment page for today. And that's a very important video to watch. Okay, don't rush into the assignment. Also, there's no rush to complete the assignment today. You have the whole week to do the assignments. You have until Sunday to submit all the assignments. There's going to be 3, across along the week. So today is the first one. Don't rush it. Just do them properly, or as good as you need to do them. Do watch the video, because it's important to understand what to do with this assignment. Have fun, enjoy it, and with that, guys, I'll turn off so you can take it for the topic of today. So thank you, guys. Perfect. And enjoy today's session.
Thank you for getting on here, Saul, and I will see you on Thursday. We're going to have a panel discussion with a lot of different traders talking about the things that we've learned throughout the week. So that's going to be very, very interesting. So see you on Thursday.
Absolutely. Thank you, guys.
See you.
See you. Okay. It's only us. Victor, my dear co-host.
How are you doing, Jonathan? I was looking for my settings when I couldn't hear you. I thought it was my end that something wasn't. So I was looking for all the settings to see why am I not able to hear you. I didn't think of that. The
our ordinary viewers of the live trading room at the 5ers know that this is something that happens when you have a live stream. Sometimes you're muted, sometimes you're not muted. It's kind of like 50-50. There's it's a game of probabilities. But now let's talk a little bit about perhaps technical analysis, because I do think that that's what you guys are here for. So why not just get straight into it here? And while I do this, yeah.
Before we start, Jonathan, I just want to pause a little bit for a few seconds, a few moments here, because I mean, if I put myself when I was starting to learn about trading and getting to know the market, and I would be in present time being able to be offered from a prop firm everything I need to succeed. People who have done it, right, who are already funded, telling me what works and what doesn't, how to look the market, how to approach the market, with assignment to guide me through the process. And at the end, with an offer, where I can get a funded account, evaluation account that I can turn into a funded account. I mean, that must be very exciting for, traders starting right now. I think just a little pause to see this. I wish I had this when I was starting trading. Everything coming together to help me become successful. I think it's such a great event. This bootcamp.
Absolutely. I can't agree with you more. It's really a wonderful wonderful thing that we have going here and all. And by the way, I want to say that the first session that we had today from Abe, our community manager, very good. I watched that one. It really laid some of the most important foundations for forex trading. Not only did he talk about the general, how the forex market worked, he also talked about technical analysis, fundamental analysis, trading psychology. So obviously, most of you watching here probably have already seen that. But if you have not seen that, highly recommend that you go check that out. And what's cool about the 5ers is we're all traders here. Everyone in the company, we're traders. This is truly a funding firm, a prop firm for traders, by traders. Everyone in here knows trading, knows the in and outs of trading. So with us, you could be really sure that even when you reach out to support, they know about trading. We all know about trading. So you're really in good hands here. And with that said, of course, if you have any questions at all, we're here to help you guys out. So I want to go back to a question I saw here from Akash, not a question, but a comment. So Akash is, and welcome Akash. You're here all the time. I'm so grateful for you. You're here all the time in almost all our live streams. And like you say here, this shot that we're watching here is something that kind of looks like what a beginner trader chart looks like. You're kind of putting all these indicators on. Now, I'm not saying that only beginners are going to trade like this. Of course, you're going to have experienced traders trading with these indicators as well. But a lot of times you'll see new traders, they put all these indicators on the chart and they try to understand, try to get signals from these indicators. But most of the time, when you're starting out, I remember when I started trading and I went on Twitter, I saw people posting these trading ideas and using technical analysis. And it just felt like there's no way, there's no way you can just put a line on the chart and then predict that price is going to go higher. But lo and behold, someone put a trend line on, price hit that trend line, and boom, it went straight up. And I'm like, okay, that got to be magic. I had no idea what was going on, and everything was just very confusing, and everything's just very overwhelming. Okay. So what we want to do in today's presentation is we want to talk about the fundamentals of technical analysis. And the fundamentals of technical analysis, even though it will include these indicators, and the indicators is a fundamental part of technical analysis in terms of having them in your toolbox. But what I really want to focus on today is to create a chart that looks more like this, where you have a focus on market structure, where you try to decipher the very core of what the market is doing. Why, not maybe not the why, but the how, and the levels, how prices respecting the levels, what's happening when a level gets tested. We are, perhaps if we have the time, we're going to talk a little bit about indicators, but what I want to focus on is the underlying foundation of how the markets move and how the markets operate. So with that said, let me start the actual presentation. Now, Victor, if you want to be in the background and take care of the comments, you're free to do so. If you want to be here so everyone can look at your beautiful face, you're free to do that as well. It's completely up to you.
It's both is fine by me. I'm gonna be here anyways.
If you want to be here and like ask me questions, that would be cool as well. I think I'm all for doing trading education and doing it in a more interactive, fun, engaging way. And we could try to make it fun, but this is technical analysis, okay? Even though I really love this, it's not gonna maybe not super fun, okay? Let's see where I have some notes here that I want to go through. Right. Okay. So who am I? My name is Jonathan Andin. I'm a forex trader, mainly focused on the forex market. I trade other markets as well, but mainly the forex market. I've been trading for 8 years now, and I'm a 100% technical trader, which means that I'm focusing on technical analysis, and I do not really incorporate any fundamental analysis into my trade ideas. So I've been working here with the 5ers for about a year now as a content creator, and I'm also the host with Victor, my co-host, for the live trading room that we got going on here. I'm also a funded trader here at the 5ers, just like Victor. And yeah, that's us. Now, what is technical analysis? So let's try to define it, right? Technical analysis is basically a method used by traders and investors. And the way I look at investors is more, they're using technical analysis on the higher time frames. They're more of a position trader. So I would say investors and traders are using technical analysis to basically try to predict future price movement. Okay, that's the underlying use case for technical analysis. And it does involve studying price charts like the one we're looking at right now to find different types of patterns in price that can help you predict future price movement. And that's basically it. Now, you can compare this to, imagine how weather forecasters, they're predicting tomorrow's weather by analyzing current patterns such as cloud formations and perhaps air currents. So while they cannot predict tomorrow's weather with absolute certainty, they can make a reliable forecast by observing today's patterns and trends. And just like weather forecasters is doing that, technical analysts, they used past and present price movements to make predictions about the future market behavior. And just like weather forecasters, they rely on specific tools to predict tomorrow's weather. A technical analyst will use a wide range of different tools to anticipate market movements. So the technical analyst toolbox is very extensive, with hundreds, if not thousands, of different techniques and tools available. And in today's presentation, I want to focus on these tools, but not all of the tools. I want to focus on the foundational tools of technical analysis. Because a technical analyst, we need a solid grasp of basic market principles like trend behavior before we move on to more advanced techniques. So imagine that a carpenter must first master the essentials like how to use a hammer and a screwdriver. And the same goes for a technical analyst. We need to learn how to master, in my opinion, market structure. We need to understand how is the market moving according to market structure. But before we take a look at the actual market structure analysis and what that is, we're going to be looking at, or just going to be giving you a brief overview of the history of TIA, because this is an interesting one. And while I plan for that, I want to ask you a question in the comments, okay? What do you think is the first instance of technical analysis in recorded history? When do you think the first example happened? So we know that there's a delay of maybe 10 to 20 seconds. So it's a bit weird asking the audience questions here because I'm basically just waiting for it. But let's see. What do you think is the first instance of technical analysis in history? So we got one saying in the 50s, 1800s, 1980 years ago in Japan, 1800s. We got a lot of people talking about Japan. 1986 by some Japanese guy. Okay, so this is interesting. If you maybe thought about a specific market, a specific Japanese person in the Japanese rice market, if you thought about that, you would be absolutely wrong because it happened way earlier. So let me take you back to England, okay? England. Imagine England in the 1600s. It's dark, it's cold, it's raining all the time. In England, back in the days, you had lottery tickets, okay? You had a lottery that were funding public projects, which became very, very popular, right? And you had people trying to predict future lottery prices by plotting the prices on a piece of paper, on a graph with the highs and the lows and the opening and all of that stuff. And with that, people were actually they were trying to anticipate the future price of lottery tickets and lottery prices. So that's actually the very first time in history that we saw technical analysis being used in the 1600s in England. But then in the 1700s, in the 1800s, in the Japanese rice market, you had a samurai. We don't know if he's a samurai, but I would like to believe that he was, because this would make it so much interesting and more fun. We had someone in the Japanese rice market inventing the candlestick pattern, okay? And that is the way that we're interpreting price action today. So imagine that someone invented this method in the 17th and 1800s in Japanese rice markets, something that we're using hundreds of years later in pretty much exactly the same way. That's quite fascinating. But then, of course, you had in the 1900s, you had a man called Charles Dow. Now, you might hear that name and think, Dow, I heard that somewhere else. And that's because the Dow Jones Industrial Index is named after Charles Dow and based on his teachings. So Charles Dow, he didn't develop the Dow theory, but he wrote a series of editorial letters to a newspaper that he co-founded called the Wall Street Journal. And then other people took those letters and combined his teaching into what is now today known as the Dow theory. And I'm not going to go into great detail on the Dow theory here, but basically in the Dow theory, you will hear things like, today we talk about smart money concept. Okay, we talk about smart money concepts like accumulation and distribution, where smart money gets in at accumulation, smart money accumulation and distribution. In Dow Jones times, he talked about the knowledgeable investors, which today we would call institutional traders. And in the Dow theory, you have accumulation, ranges, and trends that leads into distribution ranges. We're going to talk about this a little bit more when we look at market structure. But it's important to understand that Charles Dow, is regarded by many as the father of modern technical analysis. If you want to go deep into the actual foundations of TA, I would recommend studying the Dow theory and Charles Dow, or you can tune into the live trading room next week where I'm going to do a detailed analysis of this. And it's interesting too, when I asked about the history, that literally no one knew about that in England. So it's pretty interesting. But that's where technical analysis first came from and laid the groundwork. Now, the Japanese candlestick, I'm not gonna talk about in detail because Abe already did that in his beautiful presentation on forex trading. What I want to focus on is market structure and horizontal level. Let's go over to this one right here. That's the candlestick. That's the one we're not going to be looking at. We're going to be looking at this one right here. Now, most of you watching this webinar probably knows about this already. But this is the foundational way that the markets move. The markets, they tend to trend. Almost all markets out there, they tend to trend. For some reason, they just tend to trend. And technical analysis came from the idea that we're going to be, we have to identify the trends and ask ourselves, how can we participate in the trend for as long as possible while managing our risk accordingly? And this is much easier said than done. Technical analysis is rather simple, but making money using technical analysis is one of the most difficult things there is to try to master. But the key to mastering this is understanding the very foundation of technical analysis. Let me see. I can bring up the right window here. So, like I said, one of the most foundational ways of viewing the markets is looking at market structure. And of course, this is originally called market structure analysis. Now, essentially, markets, as I said, they tend to trend, moving in one consistent direction. And this, as you can see here, is categorized as an uptrend with higher highs and higher lows, or a range where you have equal lows or equal highs right here. Now, going back to the Dow theory, now imagine that you have a range here as well. This would be called a accumulation range. Now imagine if this is the higher time frames and prices coming down here into this support range area, that would be the accumulation phase that Charles Dow talked about, where the knowledgeable investor, smart money, or the institutional traders are coming into the market. When price exits this range, it tends to start a trend. And this is then the public participation phase, where the public gets interested because now it's trending and it looks like it's going to continue up. So the public is jumping on the train. Up here, you form a new range after the public participation phase, which creates a distribution range. Imagine that you're sitting in your taxi, and let me know in comment if you've ever been in this situation. You're sitting in a taxi and your taxi driver pulls up phone. You see trading view, 1,000 times leverage, Bitcoin long. If that happens, you know that you're most likely in the distribution phase. This is where everyone's just piling in. Everyone's just running to enter the market. And this is usually where smart money, knowledgeable investors, the institutional traders, they know that the liquidity is there to sell the positions that they've bought down here. And the cycle repeats itself over and over and over again on all time frames. If you understand this, you're going to have a much easier time understanding the creation and the development of trends. So that's the underlying foundation of trend analysis. Now, again, it's much more difficult than it sounds, because not only do you want to identify the trend, you want to make money trading this trend as well. Now, I wanted to make sure that this was just not a random, boring presentation. I want to make sure that we're actually looking at live examples and actually demonstrate what we're talking about here. I think that's quite important. So what I want to do is I want to go to the Euro NZD chart right here, and I want to mark out market structure, show you what I'm doing, how I'm doing it, what I'm thinking when doing it. This is also going to be part of your assignment. Now I'm not going to go into great detail on what the assignment is or how to do the assignment, because that is all in the video on the assignment page. But what I would like to recommend is, when you're taking a screenshot, press the camera up here on TradingView. Press that camera and you have different options. You can download the image and then upload the image as part of the presentation. So let's try to figure out what type of structures are we seeing on Euro NZD. And by the way, Euro NZD it's just too beautiful. Okay, it's just this chart right here. When we're talking about market structure identification, this is the one you want to look at. And this is also why I wanted you to use Euro NZD in the assignment, because if you're going to be learning how to identify levels and market structure, this is the perfect forex pair to do that. We want to be first looking at the overall trend. And let me know, what do you think? Let me know in the comments, what do you think we are seeing here? Is this one trend, or do we have different types of market structure? Let me know in the comments if you're seeing anything obvious here on this chart right here. While you think about that, and while you comment on that, I'm going to show you what I'm looking at. And I'm going to begin ranging. We have a lot of people saying range, which I assume that you're talking about this area right here, and you would be absolutely right. This is a range. Now, what's interesting about this range right here, I would say, is you have distribution ranges, you have accumulation ranges, you have uptrends, downtrends, ranges, you have every single type of market structure within this range. So yes, it is a range, but it's also everything else. And you might be thinking, what is this guy talking about? I'm talking about the fractal nature of price action. Within every move on the higher time frames, there's a whole universe of different trends. And I'm going to explain that. Let's begin by first identifying the highs and the lows. And the thing with technical analysis is it's subjective in nature, okay? If I add, let's say, a horizontal level, or if I show you what I interpret as an uptrend or a downtrend, you might not agree with me, and you don't have to agree with me. Technical analysis is more an art than a science. An uptrend to me might not be an uptrend to you. A short setup might not be a short setup for you. You might be going long where I have my stop loss. So let's begin. We have an overall low here. Now, some might say, well, wait a minute, you have multiple lows here. You have one low here, you have one low here, one here, and one here. But when looking at the overall primary trend, we're not looking at the very small, lows, the every detail of the low. We're looking at the overall structure. This is a high time frame swing point. From this area, you clearly created a low. And same thing goes for this level. You could be looking at this as a high and a higher high with a low and the lower high. But I choose to view this as one high area, one low area, high, low, and high. So the thing I'm looking at here is the overall primary trend is the moves between these points, which creates a low, high, lower high, higher low, and then we continue like this. I've been saying higher lows and lower highs and all of that for so many years now that it's very easy for me to confuse the words here, but please let me know in the comments if I say something that might be a little bit confusing. But this is the overall primary trend. Now, you're pretty much, I'm sure that you're with me here. Now, let me know, of course, in the comments if there's anything here that's not clear, and I will help you out. Now, the beautiful thing about the fractal nature of price action is that a move on the daily, okay, a move on the daily will be a lot of times a trend on the lower time frames. We're going to take a closer look at this move right here. We're going to go into the 4-hour. Okay, let's go back. Let's use the replay tool here. Back to that one. So we're going to be beginning from this level. Go to the 4-hour. And we're going to be looking at this move. Now, a move that was just straight up on the daily is obviously a trend on the 4-hour. Now, again, we can be very, very detailed with the highs and the lows. We could be doing something like this, you know. Or we could just, again, look at a overall view just to get a feeling for the actual trend. And in that case, I would just be doing this. Maybe I would just do one move here, which might not make a lot of sense to some of you, but just to demonstrate that we do have a trend here within this move. And then we do enter a range here. So looking at the 4-hour, we see that Euro NCD had a uptrend here, entered a range here, moved into a downtrend, entered another range here, moved into an uptrend, starting to form a range here. Now, what do you think will happen here? Now, of course, you know what's going to happen because that's the daily right here. But what's interesting here is that the swing highs and the swing lows on the daily is quite clearly some sort of sideways price action or ranges on the 4-hour, which, again, we talk about the idea of accumulation and distribution. So we talk about the accumulation and distribution. And remember, what happens up here? Well, you're creating that range, and then you're breaking the range to the downside to create a downtrend. So you see that from a set of higher highs and higher lows, you create equal highs, equal lows, and then you start to form a downtrend right here. So that one downtrend on the daily, or that one move on the daily, is a trend on the 4-hour. Now let's take a look at this move once again. But this time we want to zoom in on the even lower time frames. Let's see if we go to the 15-minute. Now on the 15-minute, we're going to have way different structure, okay? We can see that, again, the overall trend is to the upside. But what we're seeing here is between these moves, we have many, many different moves. So one down move on, let's say, the 4-hour is a whole different universe of trends and ranges. Here you can, for example, you can see, let's say that might be a range with perhaps a fake out, which leads into a possible downtrend here. And then a big move to the upside, which leads to a downtrend. And as you can see here, that the highs and the lows are never going to be perfect in the live market. And that's why I wanted to do this live demonstration of marking out the market structure, because it's never going to be perfect in the live markets. The one forex pair that I've found is the best when doing this is, again, Euro NCD. I think that gives a very, very clear market structure on the daily and on the 4-hour time frames. Now, let me go back here. And I would like to know from the viewers in the comment section, how many of you feel like you have a good grasp of market structure analysis and how to analyze market structure? And if there's someone out there watching this and listening, and you feel like you have trouble understanding market structure, then this is the perfect live session for you. Because if you do ask me a question in the comments, I'll bring that up and I'll break it down with the sole purpose of helping you understand, so that tomorrow or when you're doing the assignment, you will know exactly how to mark out structure.
We have a lot of we have a lot of people in the comments identifying with that question, saying yes, me. So the question you ask resonates with a lot of people in the audience.
Okay, we have a question here. Let's see if I understand that correctly. Yeah, I'm not really understanding that. You know what? Let's go, and I want to look at the breakup structure. I think one of the most important ways of, I mean, you've seen now that analyzing market structure is quite simple. Okay, you want to look at the highs and the lows. But what you also want to do is you want to look at two things. You want to look at the possible break of structure and this change in behavior. Okay, so you have uptrends, you have downtrends, but you also have the behavior of those trends. Okay, so we can look at, for example, if you have, go back to this one. Now, this is obviously an uptrend. Okay, so I want to ask you guys, where do you think you have a sign of change of behavior of the trend? So what I'm going to do is I'm going to give you a few options right here. I'm going to give you one. That's going to be one. This is going to be two. And this is going to be three. So when price reached this level, with these levels right here, where do you think the price or the change in behavior starts? Is it when price reaches this high, number one? Is it when price gets above that high as number two? Or is it when you have equal lows, number three? Okay, we can agree that everyone says three, right, Victor?
Yes.
Everyone is
almost everyone.
Three. Okay. So this is very important, guys. So I want to make something very clear here. There's a difference between a change of behavior and the break of structure. Okay, Caroline says two. Can you bring that up? Someone says two, and that was Caroline. I'm gonna bring that up if it's possible. But we got a lot of people writing right now. Yeah, that's it. Caroline says two. Now I want to explain why she's right. Okay, I want to explain why she's right. What is the behavior of this trend? Ask yourself, what's the behavior of this trend? Because we're anticipating that the behavior of the trend is going to continue. That's the whole idea with trend analysis and technical analysis. We'll look at the markets, we'll look at trends and patterns. When we have find a trend, we can expect that trend will continue. Okay, so when you hit that low, you bounce. Well, you hit that high, you bounce, 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 failure to bounce. Okay, you create a high, but you fail to hold that level. That is going to be your first sign of a change in behavior. Look at what happens if I add a trend line here. I add that trend line. Price gets below the trend line here. Price has already changed here. This is no longer the same trend. This is no longer the same behavior as previously. This is now showing us a possible change of behavior of the trend. And at number three, when the behavior has already changed, you're getting a possible range forming, because now you have one low, two lows. Price goes up, creates equal highs. Now you have two equal lows, two equal highs. You have a range, okay? And I would also argue that a range is a break of the trending structure. When you're no longer trending, you're in a range or a downtrend, right? So, well, you're in a range if you're no longer trending, of course. So you enter that range, and that is a break of structure. And then you will, of course, have a range will break structure as well. And the range can break its behavior as well. And when the range is breaking the structure, that's most of the time when a downtrend is starting. It's important to remember that an uptrend can break structure into a downtrend or a range, and an uptrend can break structure into a downtrend without first forming a range like this. Okay, so it doesn't have to be a range, even though if you zoom in on lower time frames, you will most likely find a range, even if it's only on the 1 minute. But the break of structure that is most profitable for a trend trading trader is the break of structure from a range and utilizing these distribution and accumulation areas. Now, how do we actually trade these break of structures, right? Because the change of behavior tells us that there's something going on. We might have a break of structure. So when there's a change in behavior, that's when you're going to pay attention, because the break of structure always comes after the change in behaviors. It's important to understand the difference between these two. Two of the most common technical tools that traders use in the market is horizontal levels and trend lines. And I strongly believe that technical analysis is best viewed as a risk management tools, like I said earlier. And once a trend is identified, a technical analysis will determine the entry points and, of course, how to manage your risk accordingly. And this is where the technical analyst toolbox comes into play. And like I said, one of the most effective way of doing this is horizontal levels. And a lot of people like trend lines as well. But I stick with horizontal support and resistance, or also called supply and demand area. And I want to look at a closer look at these levels and how I apply them in trading. Now, Abe, in his session, he already explained horizontal levels. So I'm not really going to go into deep into how I apply horizontal levels. I will do so in future sessions, but I feel like today I shouldn't be going into that, because we already talked about the horizontal levels with Abe. What I want to talk about, though, is just some simple rules when adding horizontal levels. Now, for most of you, I'd say 99% of you, unless you have you want to be using a top-down analysis when you're adding your horizontal levels, unless you have a profitable trading strategy where you're only looking at one time frame. But if you do that, then you already know how to add the levels. So you want to be using a top-down analysis, and basically what that means is you want to start at the higher time frames, add your levels, go into the lower time frames, and refine your levels based on what you're seeing. And you want to think of the horizontal levels in terms of horizontal lines, like this right here. I'm sorry, you want to add a line, but you want to think of the lines as areas, not exact zones. It's not going to be one price. A horizontal level is an area. So there's always going to be a buffer zone around your horizontal level. When looking at strong levels, you want to consider the number of touches. The more level is respective of price action, the stronger it's likely to be. And you also want to check the how long has the level been in play. You see many touches and it goes back maybe all the way to 2015. That's a strong level. And of course, you want to look at the strength of the reactions to the level. Let's see if we can find a live example of that. I think there's going to be plenty here on Euro NCD. Let me add a level here, horizontal level, and let me explain why it's a strong horizontal level. Let's just put something on here. Let's just do a big level perhaps here. Okay, so what you see here is quite a lot of violent and strong reactions to this level, and I want to bring your attention to this one right here. Obviously, you see price coming into a resistance area, and that the hit of that resistance initiated a very, very strong move to the downside. That's a very good level. This level as well goes back way, way, way back in time. It's been respected pretty much since the dawn of time. And you see many, many levels, this level being hit a lot of times. You also want to look at has the level been resistance and support? Has it been both resistance and both support? That's also something you want to take into consideration when looking for horizontal levels. And you want to put, when you're going to trade this, okay, so there's a difference between just analyzing the market and actually trading the market. When you're going to trade these levels, you want to put more emphasis on the most recent price action. I want you to look at the right side of the chart. You're doing your analysis on the left side of the chart, but I want you to put your focus on the right side of the chart when you're going to be trading these levels. Because what happened in 2018 or 2013 back here is not as important and as what's happening right at this current price. Because even though the markets are moving in the same direction, they're moving for different reasons. It's important to always put the most recent price action in focus. And of course, you can also, if you want to reduce the noise here when adding horizontal levels, you can go to the line chart, which is this one right here. Now, what the line chart does, it basically connects the opening of every candle, but you will get much less information. You will not get the information of the daily fluctuations. You will not get the information of the high of the day and the low of the day. So for me, I think it's best to use the candlestick chart when adding horizontal levels. But if you're starting out and you want to see the extreme highs and lows, then line chart might be good for you. But you're getting more information from a candlestick chart, which I think is better. So again, it's not really complicated. When you get the hang of it, it's not really that complicated. What is complicated is again making money from these ideas. And yeah, I mean, a trade idea based on technical analysis won't really do much if you're not able to turn it into profits. So you can't just put a horizontal level on the chart and say, oh, that's resistance. Price is probably going to respect that level. And sure, most of the time, you'd be right. But the real question is, how do you actually trade that level? And that is, of course, like I've said hundreds of times, probably, it's much easier said than done. But I want to be looking at two core principles for actually trading these levels. Now, I believe trading these levels and trend lines, and they didn't really show you how to add trend lines, but it's the exact same principles. Okay, I believe when adding a trend line, you need 2 touches. A lot of people say you need 3 touches to confirm a trend line. No, you need 2 touches. 2 touches creates a trend line, and you can trade those trend lines just the same way as you trade horizontal levels. I find that for me, the best thing is, if you're going to be using trend lines, at least also add horizontal levels to see if there's any confluence between a break and retest or a breakout of a trend line. That's also a breakout of the horizontal level. But again, that's completely personal to me. You might find that something completely different works best for you. And throughout this week, we are going to talk more about specific trading system and trading system development. So you'll get to know how to develop your own trading styles. Okay, I get some water. Man, it's already been almost an hour. It's insane. Okay. Breakouts and break and retest. Okay, so two of the core principles of trading this is using either breakout or a break and retest. You will see that most systems out there, probably 95% of all the trading systems out there, are based on some variations of using horizontal levels and applying either breakouts or break and retest concept. We can look at an example of possibly a breakout. So let's see. Let's look at that one perhaps. See if we can find a good example. Put a level on here. I'm actually going to go to the weekly here, but you have to understand that even on a weekly chart, price action will move and look very similar to the lower time frames. But here we have a horizontal level, and let's just create a zone. So we're going to incorporate more price action around this horizontal level. So we're going to doing something like that. That's our horizontal level. Now this is the breakout, okay? This is the breakout. Now, how do you trade the breakout? Well, there's many different ways of trading the breakout. You have many different orders that you can use. Again, Abe explained that very beautifully in his session from this morning. You could, for example, put orders right above the level, like stop, limit, buy orders or whatever, and then they're going to get filled when price breaks above the level. Then you might want to be putting a stop loss below the candle or whatever, and then TP perhaps at the next resistance area or something like that. But that's the general idea of a breakout. Now, if you look at an uptrend, this is an uptrend, right? And what if the characteristics of this trend looks like this? That's the breakout, and it looks like that. And you see that some of the times the levels are not getting tested. Okay, this is the behavior of the trend. The levels are not getting tested. And if you see that this pattern is repeating itself in the market, then using a breakout strategy obviously makes quite a lot of sense, because the break and retest strategy is based on the break and then having that level being retested. But if the retest never happens, and I know if you're trading Bitcoin, you know that Bitcoin loves to just leave everyone behind. Gold, for the last 6 months, when gold had a major breakout, it never retested breakout level. I think the first time that it retested breakout level on the daily was actually perhaps last week. I think that was on Thursday or Friday last week. So a breakout strategy on the daily on gold would have worked absolutely beautifully, and a break and retest strategy would not even have given you a entry and a position. So the danger of breakout trading is obviously buying a fake out. Okay, what is a fake out? Fake out is simply, could be two things. It could be the fact that I think a picture perfect real fake out is when you have one candle closing above the level and the next candle closing below the level. So for me, a fake out and a false breakout is actually two different things. And I'm going to show you why. Because if you read a book on technical analysis, it's going to say that a fake out is a failed breakout. But there's a difference. And I will show you the difference. A fake out is a move where the candle is closing below. This is obviously where it's like, I'm doing a breakout and then right back below, trapping all the breakout traders, and you're now in a fake out, right? And then it continues lower. But a false breakout is when you get confirmation. Okay, you get confirmation because there's different types of confirmations you can use to determine if a breakout is a real breakout or not. And I would like to say there's two types of confirmations. Either there's a single candle close confirmation, or there's a second candle close confirmation. A second candle close confirmation is a great way of determining if a breakout is a fake out or not. The problem with that is if you have a strong momentum move to the upside, you're going to miss it if you wait for too much confirmation. But let's look at the daily. Now, look at this. We have one candle closing above the level. If you're looking for a single candle close above the level as confirmation of a breakout, this is a confirmed breakout. If you're waiting for an open and close, two candles closing above the level, then this is a confirmed breakout. Okay, this is a breakout. This is not a fake out. This, however, is a false breakout because you're seeing the trend is actually moving in the direction that we wanted. Let's just say that we have a high and a low here, just to make it better visually. And it is moving in the same direction. It is retesting that level. It is breaking out and it's retesting. But what's happening here is it's actually ending the trend, okay? And we start the downtrend. And this, to me, is a false breakout. You can even look at it at the 4-hour. Go into the 4-hour. This is a beautiful breakout. And this could also be perhaps traded as a break and retest. But when the break and retest fails at resistance, it's most likely because of a false breakout. Now, you don't have to use these concepts, fake out and false breakout, but I think it's a good idea to differentiate between the two, because when you're developing your system later throughout the week, you want to have different ways of viewing this. You want to make sure that there's a difference between, like I'm going to talk about now with break and retest, with immediate retest and rounded retests as well. So that's the overall breakout idea. Now, understand that with breakout trading, it is good to look at the multiple time frames. So even if you're trading on the lower time frames, let's assume that you're looking at the 15-minute, you're looking at a resistance area. On the 15-minute, it's a confirmed breakout with one candle confirmation. But then you want to make sure that you also have a second candle confirmation on perhaps the 5-minute, or you want to have multiple candles closing above on the 5-minute, maybe, 2 5-minute candles closing above, but on the 15-minute, you only need one. So you have multiple time frame analysis confirming the breakout. Okay. Now, let's take a quick look at the break and retest, because I know Victor is waiting to talk about order blocks. Okay, let's see, we got the daily here. Okay, so that's a breakout. Now, what is a break and retest? Now we go back to the uptrend. And again, in this webinar, I talk about mostly buying uptrends, and for selling downtrends, it's the exact same thing, but everything in reverse. Okay. I think most of you can assume that you now understand if this is a breakout, then this is the retest. Okay, so that's the break and retest. Let me see if we can find an example of this in the live markets. Webinar like this is always going to be a bit longer, because I do want to make sure that we find live examples and not just give you the theoretical stuff. We want to make sure that we give you the actual practical stuff as well. And this is what the whole bootcamp week is designed to do with the assignments as well. Okay, I think I see one. So we have, and this is actually a beautiful example right here, because we do have a downtrend. And then if we assume that this is the start of a downtrend, we can perhaps look at this and say that we have a change of behavior here. Because here we are seeing more sideways price action. And then maybe we can zoom out and we can say, oh, you know what? This is also a horizontal area. Look at that. We got some sort of horizontal area right here. Maybe this could be accumulation range after a big move to the downside. And then what we see now is a break above that accumulation area right there. The smart money concept traders and institutional investors and everyone's just piling onto Euro NZD here, and we've had all the breakout traders. They entered here, they made lots of money, and now the slow break and retest traders, they're waiting for the retest. Okay, and what do we see? We see the breakout, and then we see price coming down, hitting that level beautifully right there on the horizontal level as well, on the high of that retest right there. What I would do in this case is put limit orders on either the retest of the breakout level, which could be the last high pre-break of that candle right there, or I would wait for confirmation, which is basically, I think this would be a pretty good confirmation candle. And then when you wait for confirmation, you can have a tighter stop loss. Again, we're going to be talking more about this in system development, but here I would just put probably limit orders right here, and then we could just trail our stops up or take profit up here. Now, what makes a good break and retest? What makes a good break and retest? A good break and retest is using the same principles of a breakout with good confirmation. Because when you have a breakout and there's multiple candles closing above the broken level, you're giving the markets enough time to accept that level as broken. So there's a difference between immediate retest and rounded retest. What if you have one big candle closing above here, but you have a fake out, or you have an immediate retest and a small move up? The market is not being given enough time to accept the level as broken, and buyers are quickly selling back into the level and probably continue this downtrend. The more time and space you have between the breakout and the retest, the better that retest will be. Okay. Now, I think this was probably going to be the last thing, but I want to talk about the difference between the first retest, the second retest, and third retest, and so on. Now, imagine that you have a horizontal level right here, and you have an uptrend going like this. You're hitting resistance. Yeah, so not to confuse people, a fake out and a false breakout is the same thing, but I've chosen to put them in two different categories because fake outs can look differently. And when developing your system and, creating nodes on different type of price structures, it's good to differentiate different types of fake outs, because some fake outs might actually be able to trade, So for me, a fake out is just one candle above the next candle below. A false breakout is when you have a breakout and the trend is continuing, but right above the level, the trend is ending, okay? Because a lot of times a fake out will be the trend coming into resistance, you got fake out, fake out, fake out, then you have a real breakout and the trend continues. But a false breakout for me is when the trend is actually ending in that level and the level fails to get reclaimed with good price action. Okay, so imagine that you have a resistance level right here and you have this. So this level consists of 100, let's just say 100 sellers, okay? We got 100 sellers. With every touch of this level, 20. Now, this is not how the markets work in reality, but it's a good way of giving you a visual of why the first retest is important. So now, with every touch, let's say 100%. Okay, so 100% sellers up here. With every touch is absorbing 25%. So we got 75%, 50%, 25%. We're now here at 25%. And then on that retest, that number goes down to 0%. Which causes a breakout, okay? Now, all of these 100% sellers, they turn into buyers. So now you have 100% buyers. What happens is, when price comes down here, this number determines the strength of this level, okay? 100% being strongest, 0% being no strength, 0% means broken. This is why the first retest after a breakout is the best retest. That's why you say the first test, best test. So I would like to, I always think in terms of first rounded retest, okay? The first rounded retest. You want to have rounded price action because now you want the market to accept this level as broken. Because imagine if you just have one breakout and then it just immediately, there's immediate retest. That means that maybe it didn't absorb 25%. Maybe it just absorbed 10%. Maybe there's some sellers left here. There's some sellers left ready to sell. They're late into the game, right? But then on that retest, you have enough time and space. What am I doing with these drawings? You have enough space and time between the break and the retest. Now, I honestly don't have time to go into the indicators, and I also know that Abe did a beautiful work of looking at the indicators, but this is where technical analysis becomes interesting, because now you have a good foundation of the structure of the market with market structure and two of the most basic principles of trading this market structure, which is the breakout or the break and retest. Now, of course, you can be looking at different ways of trading, maybe mean reversal and stuff like that, but that, I believe, comes later. Now, how do you, what, like, you want to make sure that, like, only the first retest, I mean, it's good. It's probably only trading based on this would probably, you would probably be able to be profitable with this, but you want to increase the chances of probability of a bounce. And this is where the indicators comes in, right? This is where you can add something like the Bollinger Bands, and maybe this is the middle line of the Bollinger Bands. Maybe that's the low of the Bollinger Bands. Maybe you have the 20 simple moving average or the 50 exponential moving average moving right here. Maybe you have the 50% fib right here, you know, on that retest. And this is where you create what we call, in the world of technical analysis and trading, this is what we call confluence. Okay, and you see that price comes down, it hits the 50% fib, it hits the 20 EMA, it forms a bullish engulfing candle, it forms a low time frame double bottom like Abe talked about, it forms a inverse head and shoulders. Now let me quickly go through one example. Did I just close that? Did I really just close that one that I wanted to look at? I did. I need to show you something here before we go. I think it's quite important. Open load layout. Bootcamp. Where is it? Head and shoulders. Okay. Why do I want to show you the head and shoulders pattern? Now, interestingly enough, this the head and shoulders pattern is actually getting, you know, quite a lot of hate in the world of trading, because it's like, it's the first candlestick formation, it's the first pattern that everyone learns, everyone screams, oh, it's the head and shoulders, it's the inverse head and shoulders. And it's statistically, this is actually one of the most profitable trading patterns out there. So it's funny, it's one of the most used ones, it's also one of the most profitable ones, but most people using it are not profitable. So do you understand why technical analysis and making money trading doesn't necessarily have to go hand in hand? You can be a great technical analyst and a terrible trader. Merging the two is what creates a profitable trader, which is insanely difficult to do. And one of the reasons I believe why it's difficult is because you're using too many indicators, too much analysis. But what I wanted to show you here with the head and shoulders pattern is, this is most likely what it looks like when there's a break of structure without a range, okay? So what you have here is high, low, high, all that fun stuff, got another high, comes down here, left, right shoulder, boom, breakdown. This is not a range, okay? This is not a range, but it is a break of structure. Where is the, again, where is the behavior changing? The behavior changed when that trend line was broken and when this level was broken. This right here is the change of behavior. The change of behavior happened on the cross section of that trend line and the horizontal. The break of structure happened when this level was broken. It happened right here. Now let me give you a little secret on how to trade the head and shoulders pattern. And by the way, this level here is called the neckline. What do you think that is? Well, because it's the thing that we have between our left shoulder and the right shoulders. We have the neck, and then there's a line. That's a neckline. Now, even with a double bottom, you're still going to be talking about the neckline, okay? But there's no head, so why is there a neck? Well, it's just called the neckline, and it comes from the head and shoulders. Now, let me give you a little secret here on the head and shoulders. And I want you, this is not an assignment, okay? So you don't have to do this. You'll do this next week when you're developing your system. What I want you to do, I want you to bring out the fib tool, okay? Go into the fib tool, go into settings, remove everything. It's probably going to look, well, whatever. It's going to look like this. Remove everything. Just remove everything. Everything but the 0.618, okay? Everything but the 0.618. When you have a change of structure, okay? When you have a change of structure of the trend and you're potentially seeing a head and shoulders forming, I want you to do this. And then I want you to test this. I want you to back test this. And I want you to be surprised by the results. Okay. That's where we want to have a bounce. Okay. But we're not getting a bounce. We're getting a change of behavior. We're getting equal lows. You're seeing this and you're like, okay, there's equal lows, possible range, or a shift of structure. It's a possible range or a shift of structure. When you get this, put the fib on from that high to that low. And what do you get? This high equals the 0.618. When price comes up, hits the 0.618, you want to enter on the 0.618. You want to put your stop loss above the head, and you want to put your TP on the neckline of the W. A lot of times it's going to give you somewhere between 1 to 1.5 R. But if you trade this at a high time frame resistance area, or if you flip it as an inverse head and shoulders and you trade it at a high time frame support area, you're going to have, from my back testing, a decent risk to reward above 50, which means you can take trades that are 1R or higher. And you want to be trading the completion of the head and shoulders, not the break and retest of the head and shoulders, but the actual possible completion. This is the break and retest, okay? And that one is traded a similar way, where you enter on the retest, stops above the right shoulder, and then a lot of times you want to TP that low before entering the head and shoulders. But this right here, this means that you're entering before everyone has already realized that it's an actual head and shoulders. And when everyone has realized that it's a head and shoulders, I believe that the profitability is decreasing. The profitability of head and shoulders is at the completion of the head and shoulders, not after confirmation of the head and shoulders. Okay, so that's what I wanted to leave you with today. And now my sweet co-host Victor will be taking over and talk about his favorite subject, which is order blocks.
Yes, indeed. Let's get the presentation ready.
Yeah, that's not the OTE, just to make sure that it's not OTE. This is not ICT. This is not. Yeah, let's not start the discussion, but the 0.618, that fib ratio is, you'll find it in nature. It's a very important part of math, right? And you'll find it all over nature. The OTE is the same, but just slightly different fibs. And yeah, go ahead, Victor.
Yes, so I will be talking about order blocks, of course, for everyone who hasn't seen me before. That is one of the things, one of the concepts that I use all the time, every day, in almost every moment I trade. But before I do so, my name is Victor, if you haven't noticed already. And the reason that I have a mask is that I get to call myself the masked trader. So if I take it off, I wouldn't be able to do that. So today I'm
also COVID. With I've heard rumors that you got COVID in the house.
Sure. So today I'm going to be talking about a concept which is, I think, fundamental for technical analysis. It's the core. It is something that can help you read the market better, and that's why I think it's so important, right? So reading price action through order blocks. So, but before we do so, let's start with the obvious question. What is an order block? What are we talking about when we talk about order block? What is it, right? And if you look on the internet, you get different variation for the definition of an order block. One of the first one that most people would have read, this is from Baby Pips, saying order blocks refer to a specific price area or price areas where large market participants, such as institutional traders, have previously placed significant buy or sell orders. That's a good definition. I agree with it. Although it says, right in the definition, it says buy and sell orders. It doesn't tell us, are these market orders? Are these limit orders? And how do we know where large market participants or institutional traders have placed their orders, right? Since the forex market is a decentralized market, right? So I have a little bit of issue with this definition, but it is a very solid one. We find another one. It says order blocks are areas where there is an outstanding amount of limit orders. This definition is a bit more specific. Limit orders, right, causing large reaction in the market when price reaches these areas, right? So this is talking a bit more about the reaction. I like this definition as well. And lastly, this is from a very popular figure in the forex market nowadays. I won't mention his name. This definition is the order block is the zone area in a price chart where a large number of orders are executed by institutional traders in the market, and markets show sudden strong move from that area, right? So all these definitions are very, very similar, but there are differences in them. And the thing is, I think that trading needs to be as objective as possible. And when there are more things that you need to check that depends on your interpretation, right? For example, in this definition, it says sudden strong move. What is a sudden strong move, right? I start asking myself, what is sudden? How do I define sudden in this case, in this context? Or large number of orders. How large, right? So when I want to use something, if I'm going to be using something for my trading, I want to be as certain as possible that I'm identifying the right structure or concept phenomenon in the market. And if it depends on my interpretation, it may not be as precise you might not be as precise in the identification of that structure. So although I agree with these definitions, I like to use my own definition, which is much simpler for an order block, right? And to me, an order block is simply either an engulfing candlestick pattern or an outside bar. Very, very simple, right? Next to the you can see what an engulfing is, and I will talk about it, of course, what it is, how to identify it. But this is as simple as it gets. And in trading, it's important to be, I believe, it's very important to keep things simple. So before we go into this, since I defined the order block differently and with a candlestick pattern, the engulfing or the outside bar. For those of us who want, we're starting in trading, it's important to understand, the basic anatomy. Although Abe did already start touching and explain very beautifully on this concept, I would like to review a little bit, just in one slide, what are we talking about when we say candlestick, right? Japanese candlestick. So Japanese candlesticks are a graphical or visual representation of, in this case, price, the movement of price through time. Okay, so each candle represents a specific period, time, and this candlestick represents or depicts that movement that it had in time, right? And it has a different parts, right? You have the body, of course, which is the wider part of the candlestick, and you have the lines on top and below the what we just identified as the body, and these are the wicks or the shadows, right? You have the upper wick and you have the lower wick or shadow, and together they form the candle. Importantly, and later you will understand why I'm focusing on this, why it is important. Also, the candle is formed on 4 data points, right? These data points are not open for interpretation, right? They are hard, objective numbers that we get each time a candle closes, right? The 4 data points are, of course, the open. And in this case, because it's a bearish candle, price moved from the open and closed lower, it means that it's going to be at the top of the body. At some point during the period that the candle represents, a price may reached a highest point, right? Which is the top of the wick, which is the second data point, which is the high of the candle. And similarly, during that period, the price also reached the low of the lowest point, which would be represented by the tip or the extreme of the lower wick. And finally, you have the close of the candle, right? So there you have, these are the 4 data points of each, by which each candle is formed, right? So you have the open, the high, the low, and the close. For a bullish candle, it's similar, it's the same. You have the open, but since a bullish candle, right, is opening and closing at a higher price, the open, of course, is going to be at the beginning or the bottom of the body of the candle. Okay, and the rest is as similar. You have the low of the wick would be of the lower wick would be the low of the candle. The extreme, the highest point of the upper wick, of course, is the high of the candle, and you have the close, which is where price ended at the period it represents, right? So if you understand this, which is of course very basic, but of course we are here helping all kinds of different experience level of traders, newcomers as well. So this is important, guys, for new traders to understand this concept, right? These how the candlestick is formed. Now that we know the definition, or the definition that I used, which is personal, of course, and the data points, I would like to define what an engulfing is, right? It is the body, right, of a candle, of course. The body needs to be in the opposite direction, and it needs to be bigger than the previous candle, right? The previous body. Okay? That's the definition of the engulfing. And the outside bar is the range of a candle must exceed both the high and the low of the previous candle and close outside the range of that previous candle. Okay? And I'll have a couple of examples. Here we can see the bullish engulfing, right? Where we have the body of the first candle, where we have it here. Not the first candle, but I mean the last candle here, the body is bigger than the body of the previous candle, and it is in the opposite direction, right? This would be a bullish engulfing, of course. And we have another example of a bearish engulfing, where you have the body being engulfing. That's why the name is engulfing, candlestick pattern, being bigger than the previous bar, and by doing so engulfing the previous bar as well. And it needs to be in the opposite direction, right? That's for the bearish engulfings, right? The other one is the outside bars, and here you can see clearly that the green bar not only is bigger, the body is bigger, but also that it took out the low of the previous candle, right? Remember the definition, it needs to take the low and the high, so take the whole range. That's why it's called outside bars, because it trades outside the range of the previous bar, right? So it takes out the low, it takes out the high as well, plus it closes outside of the range of that previous candle, right? This will be a bullish outside bar, right? Outside bars, by the way, are stronger, they are engulfings on steroids, as I frequently say, because they are stronger than regular engulfings, right? And the other one is another example of a bearish outside bar, where you have the same thing, just in the opposite direction. The red candle takes out both the high and the low of the previous candle, plus ends, closes beyond or outside of that range of the previous candle, right? That would be a bearish outside bar. Now you may ask yourself, but hey, Victor, why do I use outside bars as well as engulfing? Because look at these candlesticks where you see the bullish outside bar is also an engulfing. Why I don't use just an engulfing and not an extra definition as in outside bars? Well, the reason that I specifically use outside bars as well, and I define them, I look for them consciously besides just engulfing, is for the following: because not all outside bars have opposite direction in the candlestick. This, for example, is also a bullish outside bar, right? So because if you look at the definition of the outside bar I just gave you, it takes out the low of the first candle and the high of that candle, that previous candle, and it closes above it. However, if you look at only the bodies, it is not in the opposite direction, okay? However, so this is a bullish outside bar as well. However, the effect or the phenomenon or the psychology of the market participants as these two bars are formed are the same. So this is equally powerful as when it has a different or opposing direction of the candles, right? Bearish, bullish, and this one is bullish, bullish, but they have the same kind of effect on market participants, right? They went through the same process. And of course, you can have the same candlestick pattern where you have both bodies being in the same direction, but still forming an outside bar. And these I also consider order blocks, right? This would be the bearish outside bar, where it takes out the high of the previous candle and the low and closes beyond or outside that previous candle, right? So these are the order blocks to be. And I understand that, it is different than other people definition, but this is making it simple is very, very powerful. So it is important that we appreciate the fact that it will allow you to very quickly, without a doubt, identify what an order block when you have such an objective and simple definition for that order block. Well, why are order blocks important? Well, order blocks, they indicate swing points in the market, right? Reversals, you could call them, right? Where price change direction. One side, either the buyers or sellers, depending on what kind of order block it is, a bullish order block or a bearish order block, one side took control. And why is this important, right? It is important because not only it tells you that it's telling you something that happened in the past where one side took control, but more importantly, it tells you where whoever took control, they are likely to buy or sell again, right? If the buyers took control, the buyers are likely to buy again at that area, right? Depicted or indicated by an order block. That is why it's important, because it gives you a hint of what is going to happen in the future, right? And that is edge, my friend. So that is the importance of the order block. And now the next thing is, how do you mark the order block, right? For the bullish order blocks, the area that I mark is the area that extends from the body, right, of the previous bar to the lowest wick, which is, in this case, you can see the body of the previous bar. This is a bullish order block, right? Price went down first and then ended up bought up with buyers taking over, right? Taking control, what I just mentioned. And the area, it is the area from the body, right? It needs to include the body of the previous candle and includes the lowest low of those two candles. If it's the first candle is the lowest low, then that's going to be the lower border of the order block. If it is the second, then it's going to be the second, whichever is the lowest, okay? And the bearish order block, the area that is considered order block to me is including the body of the first candle and the highest point, right? In this case, it's the second bar that has the highest point. That's the area that I consider the order block. There are variation. There are people out there who include the whole candle, right? The whole range, including the wicks of the first bar, to be considered as an order block. And that's fine. I prefer to make this area as tight as possible because it lets me be more selective, right? So it's not wrong if, and you will hear this more commonly, people use the whole candle. It's okay as long as you keep on doing the same thing, because that is what will bring you consistency. Personally, I prefer to use only the body and not the wick, in this case, the upper wick, for a bullish order block. Of course, the lower wick always is part of the area, right? Because that's the extreme price went before it changed direction. All right, so that's how I mark the order blocks. Now, how to use them, right? How can you use that information for your trading? How can you profit from this? How can it make money for you? How can it? What can you do with an order block, right? Well, when you think about it, essentially order blocks are areas of supply and demand where price went. Let's say a supply area, price went up, and price was sold, and price sold off from that area, creating that supply area, letting us know that at that point there were more sellers than buyers, right? And when it does that, a lot of the times, not always, a lot of the times, it will leave clear order blocks behind, indicating the points where the sellers to control in the case of the supply area. So basically, order blocks are another form of supply and demand, which is a variation of support and resistance, right? Typically, supply and demands are areas, support and resistance are a bit more lines, although there are also areas, right? So this is the basic understanding that order blocks are just a way to read the market. Where are the sellers interested in selling and are likely to sell them again, price again when it comes to that area. And the same goes for the demand area, where buyers are willing and able to buy, whether they are resting limit orders there, pending orders or not. Fact is, by the fact that the order block was formed already gives you an added probability, right, that the market will react and buyers will come in at that demand area formed by the order blocks. So how do you use them? Order blocks can be traded when they are retested. The same thing, the same concept that Jonathan just explained, where price comes back to a break and retest, right? It makes a breakout, comes back, and gives you that opportunity to buy and get in with the continuation. That's the same thing, same concept that can be order blocks, and that is how I trade every day. That's how I got funded. Very simple, right? It is at the retest of those order blocks, right? Price forms an order block and then comes back to retest them before it continues. In this chart, you can see this is a recent EU price. This is the daily time frame. You can see how the order block was formed. There are many order blocks all over the place, but I'm identifying the one that actually were at important swing points, right? It was formed here. The order block was formed, price moved away from it, and then as it came back in to retest that order block, it changes direction. The sellers who formed the order block to begin with, they came back to the market and were willing and able to sell the market, defending that structure that they created and pushing prices much lower. The same way, you can see how the order block that was formed by the buyers at this specific swing point, as price comes back in, they are willing and able to buy it again. Not all order blocks work. Of course, price will break them from time to time, right? It is the trick, of course, is knowing which order block to be using, but at least by knowing that there is a structure here, you already have an advantage on other traders, because you have something that puts the odds a little bit in your favor, knowing that buyers, they will be buyers here because they bought this price in the past, and they're going to be buying it again when price come back. Whether it's going to be enough to make a complete reversal or just a pop, that's another thing. But as you can see, these areas created by the order blocks are basically some supply and demand areas. So this is the basic way to use order blocks, right? When price comes back to retest them, and the same way that Jonathan explained, the number of retests makes a difference. The first retest being the strongest reaction you're going to get is from the first retest. The second and the third can still be traded. However, the more retest happens, the weaker the structure becomes, right? So personally, I only trade the first retest, but the second is still profitable, and even the third is quite nicely able to be traded. So the first way to use it is for the retest, right? However, you can use order blocks since they are basic expression of supply and demand. You can also use them to protect your position, right? To put your stop loss, helping you putting your stop loss in the case of a buy order, right? And you have a bullish order block below you, you want to be putting your stop loss below that structure, right? So because you know that buyers will come in and defend that position, so the best way is to put it below that structure in the case of a buy order and a bullish structure. You can also use them as targets, right? Since you know that price will react to them, it's best you get the trade off the table before it reaches that structure, because that may be a structure that might reverse price, right? Since let's say you're in the same buy order or buy position and you have a bearish order block ahead of you, right? It's best you put your take profit before that structure, because it will make sure that the structure doesn't reverse price before reaching your target. So you can use them for stop placement as well as take profit placement, but you can also use them as confirmation signal. Imagine you have a setup, a strategy that is not based on order blocks, that is completely different, and when price comes to that area that you were waiting for price to come to, you need to get a signal, right? A signal that confirms that the setup is going to work, that it's activated, and you need to get into the trade. Well, order blocks can be used for this, because remember what I said, order blocks are a representation of a swing points in the market, right? When market switches back as it comes to your area to go into the desired direction. So you can use them as confirmation signal to get into your trade as well. And that could be in a different time frame, not necessarily on the time frame of the setup, but it can be as well. All right, so and lastly, you can use order blocks as a component, as a tool, right? Another tool in your toolbox, or as Jonathan already mentioned, as a confluence to an already an existent strategy that is perhaps not based on order block, but you can use this to increase the probabilities of the setups, right? So order blocks can be very versatile, as you can see, in how to use them, when to use them for your trading. Right, and the last thing I want to say about order blocks is that besides what we just mentioned, right, the retest and using it for stop loss placement, etc., or as an add-on to your strategy, your already existing strategy, because the order block is where the buyers and the sellers come in, right? If you conceptualize that for a little bit, if you think about it, if I know, okay, buyers came in at certain points, if I take an overview, a bird's eye view of the market, zoom out a little bit, the frequency of order blocks tells us something, right? If buyers are coming in more often, that's a bullish sign, right? So the creation and the invalidation of order blocks, they help you understand the narrative of the market, right? In simple words, you can read price action through the creation and invalidation of order blocks. And invalidation, I didn't explain what that is, but that is when the order block is broken, meaning when price that's my definition, when price in a bullish order block, when price closes below that area that I depicted, right? And in a bearish order block is invalidated when price closes above the area of the order block, right? So by reading the frequency and the degree that market is creating and invalidating order blocks, we get a glimpse, right? A tool, a way to read the market to answer the question, the main question when you are trading, which is who is in control, right? Is it the buyers who are in control or the sellers? This is very, very important, almost as important as knowing market structure. Market structure is the basis, but this is the next best thing, right? After market structure, you want to be reading who is in control. Normally, the market structure is already indicating who is in control, right? But order blocks is another layer to help you cement your confidence in knowing who is in control, right? And this is gold. This is the weekly time frame of gold. This is recent price action, and you can see how a order block, right? This is a bearish order block and a bullish order block, and as you can see there, when we have both bearish and bullish equally frequent being created, you're likely to be in a range. Not always, but you're likely to be in a range, right? Because the fact that they're creating these order blocks in opposing direction tells you that they are roughly equally strong in this area, right? And you can see how we had two bearish order blocks and two bullish order blocks being created, right? Further emphasizing the fact that equally sides, they have a chance of beating each other, right? They are strong and they're showing their strength by forming those order blocks. However, at a certain moment, price breaks this range, right? We can see that in the following price action, that the market breaks out of that range. And before it did so, it gave us indications, right? When we had two bearish order blocks and two bullish ones, it wasn't clear based on the number of order blocks which side is going to win and which direction price is going to go. However, before it actually leaves the range, it already started, as you can see here, building up order blocks, creating order blocks before leaving the structure, right? That is an indication who is gaining control. That is reading price action before it actually breaks out, right? And you can see how it forms an order block and another one on top of that, these two order blocks before it actually breaks out. And then you have this big candle, huge candle, which if you were reading price action, you would have been able to position yourself and enter in this direction because you already saw that the market was gaining momentum to the upside. So it's telling you by reading the creation, right, of the order blocks, you can get a glimpse of what's going to happen, what the intention is of the market. Not always it's going to go in that direction, but if it's going to go in the direction, it is likely to be leaving order blocks behind because that's how the market moves, right? And then it breaks out and starts creating order blocks again. But what I wanted to explain was how you can read price action by the frequency and the degree that the market creates them and invalidates them. So that is everything. Well, the basis on order blocks, and I believe it is so powerful. It's so simple, but so powerful. Can be so powerful for your trading. If you understand order blocks, you are miles ahead of many traders. So I hope this is very helpful, and I wish everyone great success with their assignments today. Are there any questions about this presentation?
You know, one of the reasons why I wanted you to talk about order blocks is because I think order blocks is, you know, the way you explain it as well is it encapsulates different types of candlesticks into the order block. And when looking at supply and demand, support and resistance, the order blocks are usually very good at identifying good support and resistance as well. So it's more of an advanced candlestick concept, I would say, that goes hand in hand with the fundamentals of technical analysis. So there's a couple of things I want to cover here. You still have time to sign up for the event, all right? So there's a link in the description of this video, btw at the5ers.com. You go to there, you sign up, and you will get an email to the event page. On the event page, there's everything you need to know, okay? You're going to have a video explaining what the assignment is, and I'm going to just briefly tell you what the assignment is here as well. We want you to upload 4 different charts of market structure. It doesn't have to be 4 different types of market structure because there's only 3. But you can have 4 charts of different market structure. It can be 2 ranges, 2 downtrends. It could be 2 uptrends, 1 range, 1 downtrend. We want you to mark that out in the trading view, hit that little camera, and then upload that. There's a video on the event page explaining everything in detail, exactly what you need to do. If you have not signed up for the event already, do that, because we're going to be doing this every day throughout the week, and you're going to get new assignments. Not every day, but you're going to get more assignments. When you sign up to the YouTube channels, as you will see when you sign up, you subscribe to the YouTube channels. And I would also like to ask you, who's already signed up and who's already subscribed to the YouTube channel, remember what I said in the beginning. We've had so many people, thousands of people subscribing to YouTube channel, which actually YouTube thinks that it might be spam, you know. So you want to make sure that you actually hit that bell notification button, because otherwise they'll be removing you from the subscriber list. So make sure they go in, resubscribe, make sure that you're subscribed, hit that bell notification button, and then check your email, check the spam box, check everything. Make sure that you have access to the event page. Actually, Victor, I think we've been going on for so long here, and I've been... We don't really have a lot of questions on the order blocks and everything, but if you do have any questions, I was going to say we might cover it tomorrow, but we're not going to cover it tomorrow. I think if it does look like a lot of people do get the grasp of this.
There is, yes. I try to maintain the topic very basic. I didn't go into, you know, all the nuances of order blocks, because of course there is, and there are different moments where order blocks may not be the best way to read the market. But I mean, that's for another level. The importance of the order block is so potent that it's very easy for everyone to recognize an order block without a doubt and use them. They're very versatile and very powerful, and they work on all markets. So it is a gem of a tool, of a method to read price action, in my opinion. But we do have one question here from Nuno. Question to Victor. Typically, what is the behavior on a first visit of an order block? Reversal or breakthrough, according to your backtest experience? Well, Nuno, when we trade order blocks in real markets, we have to consider the whole picture, right? The order block is just one thing on the chart. And of course, there are much more things happening. So if you want to understand and assess the probability of any single order block being respected, right, causing a reversal or being invalidated, price breaking through it, it is by understanding what the other time frames are telling you, right? Doing the top-down analysis. Because let's say you're on the 1 hour and you see an order block, right? What are the chances that that order block is going to be respected or not? one of the things you can do is go to the H4, a higher time frame, right? That will give you a different level of understanding of what price wants to do, because the H4, right, the H4 time frame will have its own order blocks, and price will, and the movement that these order blocks on the higher time frame that are caused, they are much stronger than the movement on the H1, right? So you have to understand not only the time frame and that single structure, the order block that you're talking about specifically, you have to understand the whole picture. And for that, we need, among others, top-down analysis to understand what other structures are here at play, and perhaps other things, right? For example, what of the range of the day, right? These things, price behaves differently when it reaches and exceeds its daily range, right? And that can also, it will have a pressure to go to the mean, right? To go back into the range. So these things, they affect the probabilities that an order block work or won't work, right? So there's much more nuance to read them, but what I want to have the people in our audience take home from our presentation is that they are easy, they're objective, doesn't depend on any interpretation. An order block is an order block because it's based on those 4 data points that I pointed out. So the area is the same for everyone, and you can use them. They're very visually very easy to understand, and you can use them for many things, and there is very powerful. Just go through your data, go through your charts, and try to find those swing points and go see if there was some structure there. And by structure, I mean order block. And you will notice that a lot of time price moves from one order block to the next one. So that's it. Thank you for your question, Nuno. We appreciate your participation.
All right. Thank you, everyone. Again, I would like to direct you to the event page for any future live stream, any future session, and all the information that you need on the assignments. Thank you, everyone, for joining here today, and we hope to see you all tomorrow, same time. We're going to be talking about risk management. And then you don't want to miss Thursday as well. Of course, we're going to have live events and recorded sessions every day of the week. So make sure that you have access to that event page. Thank you, everyone. And we'll see you all tomorrow.
See you guys tomorrow. Bye-bye. Don't miss it. Bye-bye.
Hi guys, so thank you very much for watching the video. Now make sure you like and subscribe, and most of all, go into the YouTube and check our other content that we provide here at The 5ers. We'll see you in the next one.